Look, we all know that real estate has created more millionaires than pretty much any other business. The problem is, it's also created a lot of heartaches and bankruptcies. Sure, we can get access to a ton of real estate education on the internet, but that's precisely the problem. How can we tell which strategies will consistently produce asymmetric returns and which should be avoided at all costs? My goal is to give real estate entrepreneurs, capital raisers, and investors all of the secrets so that we can grow our portfolios without dealing with costly investment nightmares. And that's what this program is all about. I'm Hunter Thompson, and welcome to the Cashflow Connections Real Estate Podcast. Okay, welcome back to the Monday Minutes. So during our mentorship program, we have calls that are every other week where I go through the action items in the modules that the mentees have watched previously. And then part of the action items is to provide any questions that you want answered during the 1 hour call. And the calls have been running a bit long. And we had one gentleman that asked some really great questions. And I figured, why don't I kill two birds with one stone and just do a Monday Minutes where I answer some of these questions? I'm sure it's not just him that's asking them. Plus, it'll give you some insight into the kind of things we talk about in the mentorship program. So I'll just go through these in order and try to give some good answers. Maybe some will be great and some maybe not so much. So we'll see. So first question is, there's a ton of dialogue in our team right now about how to get debt guaranteed. Should we be looking to the operator? Should we give some LP extra equity in exchange for it? Any other ideas? So good question. So I typically don't invest in deals where there is a personal guarantor. It's slightly outside of our risk profile. So if you're investing in a reasonably stabilized deal, you typically would not have to have a loan guarantor. Now, you may have to have someone sign that shows that they have a net worth, which is the amount of the loan. And this has the potential to be convoluted because you could have that, quote, amount of net worth spread across multiple different properties. But the key here is that if you do something wrong, then potentially a non-recourse loan may become recourse. Does that make sense? So let's say, for example, that you borrow $7 million, you put $3 million down, and you buy a $10 million property. It should be a non-recourse loan. But if you do something wrong, if you don't insure the property, if you do some criminal act on the property that creates the property to be completely devalued, that loan that's supposed to be non-recourse may turn recourse, and the loan docs will kind of outline that. So I'm hoping that that may be what you're referring to. If not, again, it's slightly outside of our risk profile to have a personally guaranteed requirement from a lender. Now, should you give some LP equity for being that personal guarantor? That's a very reasonable strategy. You know, sometimes people have upfront fees for a rich or high net worth individual who can put up their balance sheet in exchange for that personal guarantor. And that's a very reasonable strategy, and people do that all the time. Next question. Do you guys still use Pipedrive? And is there any other investor-focused CRM out there that could be really solid? So yes, we do use Pipedrive. We use it for our mentorship program. It's a very straightforward CRM. It's best for sales. You can integrate with your emails for sure. But at the end of the day, it looks like a funnel kind of thing where you basically have multiple steps. And the example we do in the mentorship program is, did they apply? Did they schedule a call? Okay, great. Move them along to the next step. They scheduled a call. Great. Did they commit to move forward? Great. Did they pay their deposit? Great. Did they create an account? Great. And now are they rich and famous because they graduated from the mentorship program? So those are the steps. We just move people along just like that. I use Crowdstreet as our back-end investor CRM. It's very robust. I just sent them a big check because what they do is it helps us a lot, but it's very expensive. So I don't suggest doing that if you're still in the process of raising your first 1, 2, 3, 4, 5 million. I would say once you're confident you can raise 5 million over a 12-month period, that it would start to make sense to do something like that. Next question. What's the best way to manage work? We've got 4 guys, and it's challenging to organize everybody in terms of accountability. Well, first of all, I would say that the best way to handle this in terms of accountability, it's really important to know your key performance indicators. Whatever the most important things are in your business, you have to have a clear line of sight into how those are going on a daily, weekly, monthly, quarterly, annual basis. If you don't know that, you don't know how you're doing. Now, each individual person should have their own key performance indicators. They should all have the main tasks that they're working on, the main metrics that they're focusing on. So as an example, every Monday, I receive an email from my assistant that has a Google Sheets that includes some of the important metrics that we track and that she has instant access to. So as an example, we have number of dollars that are committed to invest in our current offering, number of dollars that have funded in our current offering, number of Facebook likes, number of Facebook comments on our most recent post, number of LinkedIn followers, number of LinkedIn comments on our most recent post on LinkedIn, things like that, number of deals that we're in due diligence on. So I can have a very clear vision of my business very quickly by simply looking at this Google Sheet that she inputs. And that can avoid a lot of meetings. But also, if I want to track something, there's a book called Measure What Matters. And I actually haven't read the book, but the title is so good, I get a ton out of just saying the title name. Because if there's something that you think is going to help move your business in the right direction, you need to be able to measure it. So I have talked on this program before about the fact that we were really shooting for 20,000 downloads per month as a podcast. And so every week we got the update, 3,000 downloads this week. Okay, 3,200 downloads this week. Okay, 4,200 downloads this week. Okay, 4,800 downloads this week. And then all of a sudden, 5,100, 5,300, etc. And now we're cranking along at 23,000 downloads a month. And it's because we were focused on it. We measured it. We put in place systems to get to that level. So whatever the key performance indicators are of your business, number one, identify them. Number two, set up a way so that each individual team member knows what theirs is, and you have accountability through transparency. Okay, next question. Hunter talks a lot about risk-adjusted returns, just wanting to get more color into how to quantify that. So when I talk about risk-adjusted returns, the first thing I want to do, to your point, the asker of the question, I want to remove the risks that are unquantifiable, because that is where people get in a lot of trouble. Now, risk-adjusted returns is an art and a science. So sometimes unquantifiable risks, you have to go with your gut instinct. But I'll give you an example that's really, really powerful. If I'm contemplating investing in a deal with an operator that has $350 million under management, they've only worked with one property management company, they've only worked in Austin, Texas. If they're going to be purchasing their 16th deal in Austin, Texas, it's the same kind of profile, same market, same property manager, I have eliminated so many unquantifiable risks, the most important of which is business plan implementation risk. Because the business plan is a rinse and repeat at that point, because they've done it over and over again. So it's very difficult for me to say, okay, well, they're going to have a problem integrating with this new property manager, or maybe they don't really know the market. No, we've removed those risks. So then I can actually look at the numbers, because the data is going to paint a very clear picture. Things like, what's the cap rate? How are they calculating the cap rate? What do the comps look like? Is there actually a potential for distress in the market? Is there new development coming on? You see how I can actually really quantifiably assess that deal on a risk-adjusted basis, because so much uncertainty is eliminated? Now take that same sponsor, $350 million under management, all in Austin, Texas, and they're going to buy their first deal in Atlanta. Now all of a sudden, I'm incurring business plan implementation risk. How are they going to integrate with the new management company in Atlanta? Are they going to use the same software? All of these questions are very difficult to look on a spreadsheet. And so, again, to the person who asked this question, you're thinking about it the right way. It's very difficult to quantify those risks. So business plan implementation risk is the number one. The number two is debt. Now, debt is quantifiable, but if I can remove the likelihood that they, quote, don't know what they're doing, end quote, and I can also remove the likelihood that there's going to be a big challenge with us keeping investor principal because of the way that the debt is structured, that is also going to help a lot. So many times in this program, I've talked about the importance of understanding the debt service coverage ratio. And going back to the example of Austin, if I'm in Austin, Texas, and a 94% occupied asset that has 150 units in a growing and robust market, and I'm using debt that is, let's say, fixed rate or floating rate. You've probably had a discussion internally about which one of those is more appropriate. I think both are fine. They have pros and cons. And the debt service coverage ratio, the break-even occupancy, is not 94%, but all the way down at 68% or 69%, which would be reasonable based on the types of deals that we'd be interested in doing. You could see that in order for you to not break even on that deal, in order for you to really be concerned about losing money on that deal, you would have to have a catastrophic and likely very property-specific issue, the likes of which is very hard to predict. So if I'm only going to have problems paying the debt if the property goes from 94% to 68%, all things being equal, which they never are, that alone is going to help me a lot on a risk-adjusted basis. So the combination of those two, if I can get a double-digit type of return with a sponsor that is clearly in a rinse and repeat stage of his career and within this business plan, this particular investment as well, and the debt is conservative and likely will not result in investors losing capital, then I can do the deal. I can do it in 2006, I can do it in 2012, I can do it in 2019, and everywhere in between. So, next question. Any ideas on how to get leads on non-performing notes in senior housing and other asset types too? So this is a little bit outside of my area of expertise. I've actually never invested in a non-performing loan in the commercial sector. So I'm not the one to ask, but I will say that there are two options. One is to reach out to lenders, particularly regional lenders. They may have assets that they don't want to own on their balance sheet that are non-performing or in default or frequently in default. And they may be interested in selling those. Another is to do exactly what you've done when it comes to performing real estate, right? With anything that you're trying to learn, it's about identifying the thought leaders that you feel from a gut perspective you see eye to eye to, mimicking their success, reaching out to them, building relationships with them, trying to get them to share the playbook of their success so you can mimic it for your own. And I know that's not the answer you're looking for, but like that would be a new business venture for me. If I'm trying to build a business around non-performing loans, what I'm trying to do is I'm going to figure out who the key players are in that space and then reverse engineer what they have done. And it will be hard because it's a new business venture, but that's the best way to do it. And there's a million things I can say on that particular topic, but that's the best way to do it. Okay, so I guess that's all the questions, and I really appreciate you guys taking a listen. Hopefully this was important. And this is why, by the way, we don't get through all these questions in mentorship programs sometimes, at least not on the calls, because I tend to be a bit long-winded. But at the end of the day, I'm just trying to give you as many tools as possible. So if you're interested in learning more about the mentorship program, you can get access to that at cfcmentorshipprogram.com. You can click apply now, make sure to schedule a call with Adam Carswell, who handles the front end part of that Pipedrive, and hope to see you on the inside.